All right, so let's. So basically, we took a look at 4 asset classes and rather than trying to predict, that's kind of difficult, obviously. So we just kind of wanted to kind of rattle off like the bull case and the bear case, for each of these asset classes in 2023. So bull case for the S&P 500 in 2023. What do you guys think needs to happen for us to realize that?
Oh, and so we have just a little bit of structure. We all get one take.
Yep.
Okay,
Right?
sounds good.
We can't be just going 5 minutes each on the S&P 5 bull. We'll be here
And
an
just
hour
so
and
the
a half.
viewers know, Tony's looking at me when he said that.
He was
kind
looking
of
directly at you.
Because honestly, yesterday, Luke, I think you were saying S&P 6,000, and it was like a 2-hour conversation.
If
and
S&P
we're like,
goes to
that's a little
6,000
high.
next year, I'm quitting the investment world.
All right, that's on tape now.
All right. All right. Ryan, hit me with your S&P bull case.
All right. So we've got a divided government, and they are willing to work together. We just had a huge omnibus bill that passed, and we were asking for gridlock, and it wasn't the red wave that some people wanted, but we know that there's not going to be much that's changing, and companies can invest according, in the next couple of years. That there's probably not going to be any significant tax code changes. Could be, but we don't think so. And so, historically, it's been a pretty good environment for companies. So if we can shake off some of the inflation, and I'm sure someone will get to that, but you've got room to grow as a business. You can invest money. You can you have some stability. Not much might be happening, but that's a good thing. So I think that's the first point I would lay out.
Okay.
My take is, I don't see much good the first quarter, at least, of next year. But after that, as we enter into possibly a deep recession, or if we enter into any kind of negative environment, the government's going to do the exact same thing they've always done, and that's print money from the federal government side of things, and Federal Reserve will lower rates back down to 0%. And when that happens, the market's going to love it, and the market's going to rebound off of that. Maybe middle of next year, some of that's kind of possibly where it might happen as we enter that negative territory in the economy. And, once they flood the money, they're already talking about $1.7 trillion spending package, they're about to pass. What if they pass another 3, 4, 5 trillion next year and print more money, flood the markets, flood the economy, give out stimulus checks? States are already giving out stimulus checks. So that's my bull case, is that the government's going to do possibly what they've always done, which wouldn't be good for the long term, but will be good for the markets and the economy in 2023 if they completely pivot their stance.
Okay.
What do you think, Tony? You want me to go?
Yeah, go for it. We'll go around the horn.
So, I completely agree with Luke's take there. I think the first quarter is going to be rough no matter what. So we're kind of looking at a full year cycle here. And I really think obviously everyone is hyper focused on inflation. I think what the Fed is doing with raising interest rates is going to start to work. I think today I heard Tesla starting to lay people off. We hear those headlines. The bull case for the S&P 500 it's not going to be a soft landing, but a soft-ish landing, a non-disaster landing, if you will, where we finally get inflation under control and the economy isn't, left in shambles. And I think that is a very realistic possibility because we're already starting to see inflation slow a little bit. And once that does start to happen and those positive headlines come out, everyone is really waiting to get back into the market. You can see it every day when there's the smallest piece of positive news.
Yeah. Okay. My bull case is that history tends to repeat itself. And there has only been 10% of the time in the market where there have been 2 consecutive negative years. We're sitting at, for the S&P 500, we're sitting at almost negative 20% as of today, May 18, whatever it is. 10% chance that it happens again. I believe that the Fed is going to overcook it, and it's there because they're looking backwards on data. And when they look backwards on data, they're going to be late or they're going to overcook. And when they overcook, then they're going to
Go back to
pause. They're going to do
undercooking.
what they're going to lower them. Are they going to go to 0 like Luke said? I don't think so. But if we get to 5, they overcook. They will get to 4, 3.5, 4, and I think that's good. And I think that's where it needs to probably be. But they need to break everything first.
Right.
So I feel that the first half of the year is going to be volatile, like 2020, goods, bad, ugly. And then at the end of the year, when they start realizing how, recessionary things really they've caused, it will bounce back. And I think next year, fingers crossed, that we're plus or minus 5% from today's rate. That's kind of where I'm thinking. So could we be down 5% and be in that 10% category? Sure. Can we be up 2 or 3%? Possibly. But I think we will see some inner year challenges, and that could be again close to 10-15% downward. But that also comes back. I'm sorry, I'm long-winded. But the thing is like it comes back to time in the market is greater than time-ing the market.
right.
Trying to figure out when this thing's going to rip back forward, you can't do that.
Yeah, no, and I think everyone, quotes, hey, if you missed 10 of those turnaround days, and so, like, are we on the precipice of the bounce back? Because the bad news, I don't think, is going to stop. We're talking about the S&P, though, and so, like, we had a really tough experience in 2008, and from an employment perspective, we didn't dig ourselves out until 2012. I mean, we didn't get underneath 8% unemployment rate for 4 years. The market low, though, was March 9th of 2009, and same with COVID. We just shut down in mid-March, the Arnold Expo in Ohio, and the rest of the world.
I know, I was going to
followed,
compete in that.
Yeah, all downhill from there. But the market bottomed on March 24th, so it's like people weren't going outside in April, May, or June. But if we're talking the S&P, it's a leading indicator of the way everything else is going to go.
Yeah, timing the market and I know that statistic. If you missed the 5 best days in the last 25 years, you missed out on a 1.8% return.
Right. Yep. Significant difference.
It's a big difference. So, all right.
Are we going bear case or are we going all bull case?
No, let's go bear. Okay. So, what's the bear case now?
Ryan?
The truth? No, I'm just joking. So, we have geopolitical event. Ukraine has dragged in many ways, but I would just add, it's not the only geopolitical event on the horizon. Luke, we've done the conspiracy theory thing, and it's really not a conspiracy theory. China's licking its chops for Taiwan.
Right.
And just, historically, if we go back, it doesn't need to be a China thing. I mean, sometimes these geopolitical things have a way of spiraling. Like World War I was like an assassination of a Serbian
Zelensky's coming over to the U.S. today. What do you think Putin's thinking?
Yeah,
right?
So like Poland, we almost had Poland get dragged in with an errant missile lobby. And
last thing I'd want to do is hop on a plane when I'm like the president of a country that's being attacked. Like, how does that get away? How does
he's already in L.A. for crying out? That guy's not in Kyiv.
Do another Vogue photo shoot.
But so the geopolitical, situation, it could be something else. Vogue.
Anyway, all right.
But so geopoliticals,
yep.
They continue.
Yep.
So this is kind of where my take is. It's all about valuation and earnings when you put a price on the S&P 500, right? So the bear case is the economy does go to kind of crap because the Fed's hiking rates were taking tons of liquidity off the table. That gets reflected into earnings, and right now the street has earnings estimates at 6% for next year. Let's say we get a flat year, or if maybe a negative 5 or 10% earnings next year. When recession, usually it's negative 25 or 30%. So negative 5 or 10% would actually be less than what's historically happens during a recession. If we get lower earnings next year and the market has lower valuations because of lower earnings as well, we could see S&P 500 go back down, retest lows, if not even go lower than that, maybe another 20% from here.
Yep. I think you guys hit all the major points there. The war in Europe, I think, is really going to have a large psychological effect on Europe in the winter as well. So that's something that we could see bleed over into the U.S. economy. I know we talked about like the wealth effect last week when you feel wealthier, you spend more. When there's all kinds of troubles going on in the world, you're likely to spend less, and that's already with a slowing economy. So yeah, kind of just more of the same what we've seen in this last year, continuing into 2023 would be the bear case for the S&P.
Okay. I'm going to stick with earnings. I don't know how long most companies can service debt over 5% when it's been near zero for years and years and years. And it wasn't an easy into 5%. It got there quickly within a year. And I think you will see this, the layoffs coming because of tightening the belt, but also the get out and travel play. Everyone's locked in. So it's mad rush for mad people to service people that want to go down and this whole cycle is going to just slow down. And when it slows down, we're don't need all these these people. The people that are being sought after eventually won't be, because we're done spending. We're getting back to normalization.
Right.
And so servicing debt, normalization. You're going to start hearing this through earnings, I believe.
What's interesting is a Fed pivot. That's what everyone seems to be talking about right now. That's actually the bull case and the bear case at the same time. Like a Fed pivot, to lower interest rates, that people think that's a bull case because that means maybe valuations will go back up because the discount rate's lower. They'll stimulate the economy. But at the same time, a Fed pivot means that the economy's in shambles at the same time and earnings are down. Right. So it's like a bull case and a bear case at the same time.
I saw the ones. Again, I'm just looking at statistics, and it was as soon as they pivot is when the market falls off the cliff.
Yep.
It's the lead up to the pivot. They're like, oh my God, they're getting close to end. Oh, they're at the end. The thing just craps out. So you're right. I think it is kind of the blessing and the curse.
Yep.
So we'll see.
I saw someone refer to what you were just talking about as the reverse Tepper trade. Not our favorite Tepper, the second best Tepper in the world, David. David Tepper. So in 2010, he said exactly the opposite of what you said.
What is that?
Tapper from
Tapper.
Tapper.
But anyway, so he said in 2010, the exact opposite of what you said, hey, the bad news is good news. So the Fed's either going to have to come in and support the economy, or the Fed won't have to come in and support the economy. And in both instances, good. A lot of people are referring to the exact opposite this time. It's like the good news is bad news because the Fed's going to have to go the other direction, and the bad news is clearly bad news if the Fed's going to have to continue to be dovish. So I agree with that sentiment exactly. And also we can't move on without discussing inflation. I mean, what if inflation is even stickier than, people have been saying for a year now? Oh, hey, it's temporary, transitory, tertiary.
Well, the wealth effect. So gasoline
Yeah.
is cheap again, right?
All is
but
fixed.
I just, again, reading an article saying hey, once China opens up, expect it to zoom back over $100
because demand goes up. Yeah.
Demand goes up. They're not doing anything over there supposedly. So,
So and we got the great news that we're only 7.1% this month. So it's that's not great news really. And so if it drags on a little bit longer, I mean, the bear case is fairly easy, I think, but we should definitely mention inflation's effect.
Well, that's the ultimate worst situation is if inflation's sticky. That's the ultimate bear case. If the rates have to go from 5% Fed funds rate to 7 or 8, if they went to 7 or 8%, the whole economy would essentially break at that point because the floating rate for debt, servicing debt would go up. You'd see defaults all the way from the bottom of tech, high tech growth companies go under. That would go a snowball effect. That would be the ultimate bear case scenario. I would hate to see that happen. And that would not be good.
Well, that's already happening in the auto industry. They're talking about the used car market.
Yep.
Right.
Anyone who bought a used car and financed a new car in the last year-ish, year and a half, these auto industry guys, get you in a new car, we're going to roll over negative equity. So, I mean, it's this really bad.
Yeah, what happened in the housing market in 08-09 is happening in the auto market, essentially.
Yeah.
Well,
all right. So
just like 2008 though, it was a good run for that year. I mean, you could
that year.
Well, we had a good run for 13 years, so now it's time to take the medicine.
Right.
All right, bonds, bull case. Go for it, Ryan.
Rate hikes end.
Right. Rate hikes go down.
Yeah,
or they're not hiking anymore.
Maybe the Fed sees data that it likes, and not only do we the pivot. I mean, maybe a pivot comes into play. When I think pivot, I think we go the other direction. The Fed lowers. that's not on my agenda, but like, hey, maybe we move up the time that the Fed says, hey, we're not going to raise rates anymore. Maybe that's March. Some people think it's March. Maybe it's hard. It's hard for me to see that, and we're all probably. I don't know if anyone actually believes that when we're talking about it, but hey, stranger things have happened. Fed moves up, and they also maybe pivot towards the end of the year and say, hey, we got to be a little bit accommodative, and we're going to lower by a quarter. I don't know.
All right, hear me out here.
Oh boy.
Oh, here's the
The
bull.
bull case for bonds is the bullish case for bonds is the bearish case for stocks. And what we've seen is bonds be attached to stocks the past 2 years. Historically, bonds are a safety trade. So when the economy is in shambles, stock values go down, bond values go up. So it's a flight to safety. That is my bull case, that bonds return to historically how they act. It is a flight to safety no matter what the Fed does, raising rates or not. Obviously, raising rates is a detriment to bonds, but I think bonds need to act like they have historically and go back to being that safety trade and appreciate in value when stocks go down.